first question and talk a little bit about what we did in this chapter, or at least this module so far. So we looked at the accounting cycle, analyzing transactions through the accounting equation. We went to the book of original entry, which is the general journal, then the book of final entry we posted to the ledger. Then we prepared a unadjusted or an unadjusted trial balance, which you see here. It's the last thing we did. And then we asked you one question. And that first question was whether or not the trial balance, if all debits equal credits, means that it is correct. And as we explained to you, trial balance just ensures that debits equal credits, doesn't mean that it's correct. It's possible that you could have debited and credited the wrong account. There's lots of things that could go on as well. So if you debit an account for $5,000 when it should have been $500, as I said, it could still be in error, although debits equal credits. Now, we're going to give you solutions to that diagnostic, but here are just some questions for you to consider. Question number one, again, we're not going to go through all of these every time, but I will give you the answers. So I want you to practice this question. The answer here will be C. This is an unearned revenue, so that if you collect $21,000 in advance, it's a liability. So remember, you would debit cash and you credit the unearned revenue on that. And that's something that we'll spend a little bit more time with in the next module, that it is in fact a liability if you collect in advance. And what are some examples? Insurance. Somebody pays you for a 3-year insurance policy. In this case, somebody pays you a monthly rental, but they pay you in advance. It could also be subscriptions to health clubs. It could be season tickets to football games or soccer matches, whatever it may be. Anything that you collect in advance is a liability. Any questions on it? Anyone with any questions with respect to why this is a liability? Why would this be a liability? Yes, so you paid first, and then you owe service. So this is a case where a liability could actually be paid off with service or inventory or something, rather than a liability that's paid off in cash. So this liability, we'll show you that in a bit, will be paid off with goods and services. All right, so the next one, these are inventory questions. We're not going to get to these until a couple of chapters from now, so I'm just going to leave those, and I just want to get to these other questions are also inventory and sale questions. I want to do numbers 4 and 5, which relate to what we just covered. And 4 and 5, 4, it says that we have, choice 4, which the following errors will be revealed by the unadjusted trial balance, and that would be letter D, where you have a debit of $50,000 and a credit of $5,000. That will obviously put the ledger and the trial balance out of balance. But if you debit supplies expense, look at A. If you debit supplies expense instead of salaries expense, the trial balance is going to balance. If you inadvertently omit an entry completely, it's still going to balance, right? And C, if you post the same journal entry, let's say debit, rent expense, credit, cash, do it twice, it'll still balance. So the answer to that one would be D. And we'll do more where I'm going to ask you as we move along. I want to make sure everyone has clickers, and we'll do one more of those today. Now this one says what's not going to be revealed, and that would be, again, this will not show up. Salaries expense debited instead of supplies, or vice versa. If you miss one side of an entry, clearly that won't balance. If, again, you post the debit and credit incorrectly, 50 versus 5, and here, this is a transposition. You transpose the number, and that will not balance as well. So the only one that you would not find that would put your trial balance out of balance is going to be the first one. All right, so just wanted to be sure we at least brought you a little bit back to where we were regarding the trial balance and the recording process. So if you have any questions on anything we did on Tuesday? All right, so with that, it's okay. Let's go to 3. Let me know all right, so in module 3, we're going to continue the cycle. And I'm thinking that this, in my opinion, is going to be really one of the most difficult areas, and that is the adjusting entry. So we are going to look at first the need for adjustments. We'll talk a little bit about accruals and deferrals. But we're going to be now looking at step number 5 in the cycle. So what we've done so far is we've looked at the 1, analysis of the transaction. Second, we did the journalization, posting, the unadjusted trial balance, and now we're going to look at the adjusting entries. Adjusting entries tend to be the most difficult, so we will spend a bit of time on that, as you'll see. So what are adjusting entries? The adjusting entries result not because there are errors, it's because accounts have not been brought up to date. That's the key. So in other words, in that example I started us off with respect to the unearned rent, maybe you had 12 months unearned rent, and by December 31st, 1 month is earned. That means that 1 month has to be then brought into revenue, and the liability is reduced. So you've got to look at all of the accounts and determine whether or not the accounts have been brought up to date. It's not that they're wrong. It's not that there are errors or incorrect information. It just means they have to be brought up to date. A classic example is depreciation, where you depreciate something once a year, maybe last December 31st. So for this first quarter, let's say March 31st or the end of September, you have to bring the depreciation up to date. So it's just a matter of thinking about adjustments as not being errors, but simply being sure that we look at the accounts for unrecognized transactions and accounts that have not been brought up to date as of the date of the financial statements. Now the problem, as I say here, is the fact that we use the accrual basis of accounting. The accrual basis of accounting means, as we'll see more formally, we recognize revenues and expenses, recognize revenues when they're earned, recognize expenses when they're incurred, regardless of when cash is received or whenever cash is paid. That's a cash basis. By using the accrual basis, we have to recognize revenue based on economic activity. So, for example, if you go to your job today after school and work part-time, you don't get paid today, but you've actually earned revenue. So we have to record that revenue as it's earned, regardless of when you actually receive the cash. The person you're working for has incurred an expense, and they're going to be charging an expense even though they haven't paid it. The other problem, and the most important problem, is this time period assumption, or sometimes periodicity concept. And next week, when we go over the conceptual framework, we're going to spend lots of time on all the concepts. And once again, as I said, just as a sort of a friendly reminder, when we do theory, it's as important, if not more important, than the numbers. So what a lot of people do when they take intro to accounting is they kind of relax when there are no numbers being put on the board. That's probably 40% of the profession. The profession is judgment and theory. So we have to think about this conceptual framework. And in the conceptual framework, we will find this time period assumption. The time period assumption is the reason why we break up the life of a business into artificial periods of equal length. Is it a month? Is it a quarter? Is it a year? The only way you know that you're a true profit and loss is to liquidate the business. Now, I'll give you an example. Broadway plays use what is known as venture accounting. Venture accounting is what was used initially for any of the explorers that explore different parts of the world. Somebody in royalty or one of the kings would give them money to explore a certain part of the globe, and they would come back and they'd say, okay, it cost us $1,000, and we brought back something that's worth $2,000, so we earned $1,000, and that's it. And the venture liquidates. A Broadway play is just like that. A Broadway play is exactly the same. You start off, you run the play, you end the play, you find out how much you made. That's venture accounting. We can't work on venture accounting because of the information needs of our users, as we'll see that next week. So we've got to break the life of the business up into artificial periods, and that's the problem. When you split a month, when you split a year, when you split a quarter, you got to have that cutoff. And the cutoff is the most important thing. Even for an auditor, you got to make sure you've captured all of the expenses, whether it's 3 days, 2 days, whatever it is in that period, it has to be measured. So this is what makes these adjusting entries a lot more difficult, and that's the time period assumption. Now, when we look at these adjustments, we're going to have two things to remember. Key points. Adjusting entries never involve cash. So my head explodes when I'm grading papers and someone uses cash in an adjusting entry. Adjusting entries are internal transactions. So these are transactions that are done inside the company. They're adjustments on the company's books. They don't involve anybody outside of the company. So there's absolutely no interaction with anyone outside of the company. And there's no cash. Never. I mean, if you don't understand an adjusting entry, just remember, don't put cash. Just don't even think about it, because there's no cash involved. The other important thing for you to remember is they always involve one balance sheet and one income statement account. So an adjusting entry will always involve one balance sheet and one income statement account. Now, we're going to see this, and I always say you'll find as we go through the course, the approach I use is always to build the understanding first and then show you how to do it with numbers. And I use a concept that I call CPA, or a technique. It's a concept, practice, application. So you'll always find that I'm going to give you an explanation up front first. So let's just see what these adjustments look like. We have two types of adjustments in accounting, deferrals and accruals. A deferral means the cash event comes first, before the economic event. And deferrals are always previously recorded. So deferrals will be a little more difficult because you got to look at the ledger and the trial balance and see what's recorded in order to adjust it. So something's already there. You've either collected cash in advance or you paid cash in advance. So deferrals, cash event is first and are already on the books. An accrual is where an economic event comes first, no cash. So there's no previously recorded event. So more specifically, when you look at these deferrals, where the cash event comes first, this is where you've got cash paid or collected in advance. You have prepaid expenses or advanced collections. Prepaid expenses are sometimes called deferred expenses or deferred costs. Unearned revenues, advanced collections, those are liabilities, and they have to be adjusted. So these are the two types of deferrals. Deferred revenues or unearned revenues, deferred expenses or like prepaid expenses. Now, it's interesting that a deferred expense is not only something like prepaid rent, it's not only something like prepaid insurance, it's also including buildings, equipment. When you buy a building, you're prepaying for future service. And I think I brought this up on Tuesday when we talked about the nature of an asset having future economic benefit to the company versus an expense. So even a building could be a prepaid service in a sense. Prepaid service. All right. So deferred revenues, as we said, there's a liability. So just make sure you remember when you have deferred revenue, you have a liability. And when you make the adjusting entry, revenue will be recognized and the liability will be reduced. We'll show you that in a bit. So, in the example that we had on the prepaid rent, you have a liability, and I asked, or at least mentioned, that revenue, when it's recognized, the liability is reduced. The liability is reduced by either giving a good or service, and we had answered the question before, saying that, yeah, you're going to give a service or a good, that will actually relieve you of the obligation. So here's an obligation that you've got paid off by providing a service, not necessarily paying. And deferred expenses, or where cash is paid in advance. As I said, prepaid insurance, prepaid rent plan assets. It's usually recorded as an asset first, and the expiration of that asset is going to be recorded as an expense. So when you make your adjusting entry, I'll formalize this later, you have an expense recognized and the asset is reduced. So when you use up prepaid insurance, you got an expense. When you use up prepaid rent, you got an expense, and then you reduce the asset. And again, these are just definitions for coming up with at least an overview. So, deferred revenue, cash collected in advance, it's a liability, and when you make the adjustment, revenue is recognized. So, again, to summarize, that's what I want to do now, one for you, so that we have a deferred revenue. Or unearned revenue. It's cash collected in advance. As a liability, reduce revenue and recognize revenue and reduce the liability in your adjustment. Now that's typical. I'm going to tell you there are exceptions. There is a possibility that you could have recorded this as revenue originally. Second type of deferral is where cash is paid in advance, record as an asset, and then when you adjust it, reduce the asset and record the expense. So remember, there's always one income statement and one balance sheet account. Okay, so Sean, I want to help you with this. We said that there's always no cash, you notice, so I'll make sure that's true right here. Again, just a basic, at least a baseline question. What are the balance sheet accounts affected and what are the income statement accounts affected in the adjustment? Three others. Which one of these did you find on the balance sheet? liability. Right, so that's your balance sheet. So then this has to be the income statement. Okay, great. In this case, one balance sheet, one income statement account. Which is the income statement, which is the balance sheet? Which one?
The balance sheet.
Which one? Yeah. And then this is the, great. So no cash, always have a balance sheet, and you're always going to have an income statement. All right, so that's your first type of adjustment. We're going to see numbers, but again, set up the accounting, the debits and credits with some theory. All right, next type, we've got accruals. And in an accrual, the economic event is before the cash event. These are not previously recorded, so this is where you have a problem. This is where you get information from a bank that you got interest income, or you got a cell phone bill and you find out you owe a certain amount to Verizon or T-Mobile or somebody for that bill. So you don't have anything recorded, you've got to wait for that information to come in. So accruals are events that took place, they're unrecognized and unrecorded at the end of the accounting period. So accruals are events that have already taken place, but have been unrecognized and unrecorded at the end of the accounting period. So we've got accrued revenues and accrued expenses. And accrued revenues are revenues that are earned, uncollected, unrecorded at the end of the accounting period. That would include bank interest on billed services, as we said. And notice that a receivable, a balance sheet account, and a revenue account are recorded in the adjustment. So when we take the second type of adjustment, accruals on an accrued revenue, not previously recorded. Receivable is going to increase and revenue is going to increase. Because it's unrecorded, uncollected at the end of the account. And once again, not to ask the question again, no cash. Balance sheet and your income statement. So I'm trying to give you a framework. No cash, one balance sheet, one income statement account. I'll take some questions in a second. All right, accrued expenses. So this is the framework, and I've got some other summary information for you later as well, but that's the framework. So any questions on the adjustments? This is the universe of the adjustments, and by the way, when you look at prepays, if this was a building, same thing, you would have depreciation expense in your adjustment, and would reduce the asset by accumulated depreciation. It's going to be very common. And that's one of the things you have to think about as you go through the advanced courses, advanced accounting, intermediate accounting, that there's always going to be similarities. So you can fall back on this framework all the time. And there's going to be transactions that are going to look the same, and the accounting will be very similar, as you see. All right. So now let's take a look at some of the questions. And I'm going to fire off some of the questions. So let's just do the first one. I'm going to start the clock. And true and false. A is true, B is false. Let's see where you are. We'll talk about it. Okay. So 63% say it is true that deferrals occur when a company receives or pays cash before recognizing the revenue or the expense. So it is true. And let's make sure we reinforce why. When a company receives or pays cash in advance, it will recognize revenue later in the adjustment process. Next one, I'm going to talk to you about without the use of the clickers. I want you to understand here that the company initially records a deferred revenue as a liability. The adjusting entry must increase the liability account. That is going to be false because you've already recorded the liability, so that if you had the advance collection, the liability is already recorded, the adjustment reduces the liability. But here's the question. Can you recognize the deferred payment or the advance payment as revenue initially? Could you do that in your accounting system? Does anyone think that you could? I'll get to some specific people in a second. Does anyone think that, let's say your accounting system, your information system is set up, and it recognizes the liability, recognizes the advance collection as a revenue. Is that possible? Yeah. I mean, what if you have an information system, a computer system? You know, you're working at a cash register, you scan the product, somebody gives you cash. How do you know if they're taking the product with them or they're taking the service with them? What if they paid it up front? What if someone says, I'll pay you for it now and you can come and do the service later? My cash register is not as intelligent as it should be, so it's going to record it as what? As revenue, like every other 100,000 sales that run through that cash register. So here's the question. If it's originally recorded as revenue, what is the adjusting entry? And Barnes, what would be the adjusting entry? If I originally recorded, what would the adjusting entry look like? If it's originally recorded as revenue, what would you think? Yeah. You got to increase your liability and reduce your revenue. Exactly. So it's just the opposite case. You're just going to flip this if it has, as I said, if it was recognized as a revenue first. And it can. So what I want you to do is start thinking that, in practice, in reality, when you get out into the field, you're not going to find textbook situations. And that generally happens because in an information system like that, years ago we used to call it the dumb bookkeeper argument. Now it's kind of like the dumb computer. I mean, the computer just can't differentiate transactions. The same thing's going to be true here if you cut checks. Every time you cut a check, it's going to go in an expense account, right? Even though it may be prepaid as an exception. So unless your computer system is fine-tuned perfectly, it's not going to pick that up properly. Good. All right, so just let's do number 3. About over and understatements, so to be sure. And by the way, number 4 is true. That's the definition of number 4. Doing number 3. it said 57. It said 57%. So 57% said that it is true, 43% said it was false. So let's read that. It said if a company fails to adjust a deferred revenue as a liability, the revenues will be overstated. The majority of you said yes, it's understated. It's understated. Because the adjustment is going to recognize increased revenue. So if you don't make that adjustment, you've understated your revenues. So that one, it should have been false. It should have been false. 57% said it was true, it should have been false. Revenue is not overstated, it is understated. What is overstated is the liability. Yeah, because if you're supposed to make an entry that records revenue, but you don't make the entry, the revenue is too low. It's understated. So the entry was supposed to show the revenue, but doesn't, and therefore it's understated. All right, so that is the introduction to accrued revenues and expenses, deferred revenues and expenses. Now we move on to the next small little chunk of info, which is going to be our details on the deferred expenses. Good. All right, deferred expenses. So now we're going to spend time on the details of deferred expenses. So again, we're on step number 5 in the cycle. We are looking at the adjustment process. Once again, deferrals. Cash event before the economic event, or the economic event is after. We also call these prepaid, deferred, or capitalized costs. When you look at this, we assume that it's going to be the norm. And that is, the typical case is where the asset is recorded and then reduced over time. So let's explain the expense-asset relationship. What will happen is that initially there'll be a cash outflow. Right? So you've got a cash event first. Now again, that's why once when I ask the question, you could also do this in terms of expenses as well. So for example, I could record it as an expense immediately, and then if I have to make the adjustment, I have to add it to the asset. But the typical way we do this is we take the cash flow and we'll record it as an asset. I want to be sure you understand the term capitalization. When you record something as an asset, it is said to be capitalized. That's the term we also use. So capitalized means to record something as an asset, it's prepaid, and it is an unexpired cost. It's an unexpired cost. So it still has future economic benefit. As the asset is used in operations or is consumed, then it's expense. So notice the cash flow takes place first, then in the adjustment, there's no cash. There's going to be no cash. Prior to the adjustment, if you don't make the adjustment in this case, assets are too high, overstated, expenses are too low, understated. Adjusting entry, as we said, we recognize the expense and reduce the asset. Here's an example. Let's assume that on October 1, we have a Delight Baking Company, pays $4,800 to Topps Insurance Company for a 1-year policy that is effective October 1. Monthly adjustment. The adjusting entry on October 31st is to take 1/12 of that payment and recognize it as an expense. So what we're saying is that you had 4,800 here. You originally reported it as an asset, and then as time goes on, or if you're making this adjustment on a monthly basis, it's going to be $400. So the adjustment is going to move 400 out of the asset category and into the expense. So you already paid your cash, you set it up as an asset. Every month you're going to move 400 out of the asset into the expense category. Any questions on the adjustment? Now I had a question that I have listed below. This up. And that question is, what was the original entry? What was the original entry? So, Nancy? Yep. What was the, you know what the original entry was here? Okay, you got it, prepaid insurance and credit. So the original entry would have been debit to prepaid insurance and credit cash. And so that would have been your original entry. Recorded as an asset. Yeah, Pedro?
While doing the calculation, should I post it in the journal entry? The way it's there?
Yeah, I mean, I would, that's a very good question, because on an exam, for example, you know, if you got this number wrong, but you showed the calculation, it's a good idea to do that. You don't have to, I mean, it's not part of the journalization process, but it's a good idea. You put it below the entry or somewhere, but it's very good. Absolutely. All right, so any other questions? Yeah, you might have noticed something that I had on the board before, but I'm going to show it to you here. The good thing is you can always do a logic check. So what I mean by that is you should always be very careful. And I know on exams sometimes, you know, it's going to be tough to actually take the time to do this. But, you know, looking at a homework problem or studying, look at those T accounts. After you make the adjustment, make sure they're right. Make sure it makes sense. So when you look at the prepaid insurance, you got 4,400 left. That's 11 months. That makes sense, right? And you expense 1 month, so that's the way it should be. So just make sure when you go in there that you can see that the balances make sense. The balances make sense. All right, so that's one type of deferred or prepaid. Anyone with questions on it? Anyone with any questions at all? Again, we're here trying to review the basics, so we're ready to go when we hit it. Tony?
What exactly is expired cost?
Expired cost is the expense. So an asset is an unexpired, meaning it has future benefit. Expired means there's no future benefit. Any other questions? Let's now do the, and by the way, again, just to make sure, one asset, one balance sheet, one income statement account, no cash in the adjustment. Now again, let me just go back and just repeat one thing here. And we'll talk about this as we move through the semester. Well, I was going to let you know that the expense capitalization alternative, management's judgment, has always been a big issue in terms of a lot of accounting manipulation or accounting fraud. So for example, if I wanted to show higher income, I may take expenses and inappropriately call them assets. How can I do that? Well, let's say I'm buying inventory and I've got shipping charges. Are shipping charges freight in? Is that part of the inventory or is that an expense? Some people might say it's an expense, some people might say it's an asset, and that's going to shift your income. I mean, eventually, don't forget, accountants, all we do, by the way, is we shift numbers between accounting periods. That's all we do. Because as I said, venture accounting, when the business collapses and game's over, you count your cash, got left versus what you paid in, that's your profit. But during the life of the business, we have these test readings, and what if I expense it first? My income will be lower. What if I call it an asset first? My asset will be higher temporarily, but eventually it always gets expenses. So the expense capitalization alternative has always been a major issue in accounting. We're going to see that most accounting fraud takes place on the expense side. Most accounting fraud takes, I'm going to call an expense, and Tony, when he asked the question about expired, I'm going to take expired costs and call them assets. And I'll justify it in some way. And that'll mean my income will be higher for this period, eventually. So now let's look at another expense capitalization issue. For long-term assets, we generally don't worry too much about that issue in general. I mean, there are some cases where we do. But we're going to talk about the depreciation of long-term assets. Just going to review that with you. And as you can see, depreciation is a process of allocation that allocates the cost of an asset to the future periods of benefit. It is not a valuation process. It is not a valuation process. So you're not, when we talk about the net book value of an asset, or when we talk about the net carrying value of an asset, value is not really what? Market value. It has nothing to do with the real value of the asset. It is allocating the cost. So when you purchase the asset, it's like a long-term prepayment. Depreciation is an estimate, and therefore we use a contra account in recording the adjustment, and that's accumulated depreciation. Now, whether you picked this up when you did this during the intro class, point D is sort of important because why, when we did, and I answered the question before about, the original entry, but the adjustment debited the expense and credited the asset directly. So for prepaid insurance, prepaid rent would reduce the asset directly. Why is it that we use a contra account for depreciation? So, I think you remember that when we set up the depreciation account, we've got the equipment, let's say, and the cost is debited, and when we reduce the asset, we credit that to accumulated, we don't credit the asset directly. We do show this as a single unit net book or carrying value, but we don't credit the asset directly. And the reason for it is a couple of reasons. Number one, equipment is at cost, and that is probably the only factual information we have. And depreciation is only an estimate. And that estimate can change. So what we're trying to do here is separate the estimate from the fact. And we want to make sure we preserve the historical cost by separating that out from the factual information. So we want to be sure that we keep historical cost preserved. We want to make sure that the cost is not affected by the estimate. So, and by the way, these estimates could change. We'll see that a little bit later in the semester. A couple of weeks from now, we'll talk about accounting changes as well. So we do use accumulated because depreciation is an estimate. Now, when we move to the adjusting entry, let's take a look at what we do. And again, we're keeping it simple because we will, and I'm going to tell you, one of the good things about the course And you can't really get fooled by this. The beginning of every chapter actually does intro to accounting. So when we do the planned asset chapter, the first thing we do is basic depreciation, and then we pick up the intermediate topic. So we're going to review all this again. But in straight line depreciation, we have Bellow Company buys a $60,000 machine in cash, and on January 1 of 2019, and the useful life is 20 years and no scrap. So the straight line depreciation, and again, I'm putting it here, I'm just no scrap value, right? You know that straight line is cost minus estimated scrap. The estimated scrap value is 0 in this case. Depreciating after 20 years, I debit the depreciation expense, and I credit the accumulated depreciation. The entry then would be posted, as you can see, to get the carrying value of the asset. So let's say we depreciated for 3 years. Sorry about that. So if I depreciated it for 3 full years, the net book value is going to be $51,000. And as I keep depreciating it, the net book value goes to what? 0. Yeah.
Why is depreciation expense debited and accumulated?
Okay, so the depreciation expense, let's go back here. So we'll leave it as a framework. You look at the asset as a prepayment of service. As it's expired, as it's used up, it has to be expensed. So the asset has to be reduced. Now, technically, what we could do is debit depreciation expense, credit the equipment account. We could do that, but as we said, we traditionally have had a separate accumulated depreciation account because we want to keep that estimate separate. But it is an expense because the asset is being used up. So it's just like any asset you buy. Your cell phone is worth less than it is the day you bought it. Your car is worth less than it is the day you bought the car. So that loss of value has to be reflected in the depreciation. That's why it's an expense, because it's used up. Part of its service is gone, right? And that's the point. It expired. Now, another important way to look at this, and I'm glad you asked the question, is right down here. Notice what happens. We're going to see this maybe not today, but again, we'll probably bring this into next week. But if you look at the depreciation expense, let's get this one number. In year number 1, you debit the depreciation expense, credit the accumulated. Notice that this gets closed out to retained earnings. And if you remember from yesterday, retained earnings is part of your equity, your wealth. So your wealth is declining. So just take your personal automobile. Your car lost value today, your wealth has gone down. You could have sold the car yesterday for $500 more, let's say. So that loss of wealth eventually gets transferred to your equity. So you always have to close out those expenses. And the same thing happens in year number 2, where that is closed out. All right, so those are the, yeah.
You close out the account for accumulated depreciation when you use up all the...
Okay, so you don't close balance sheet accounts as a rule. But okay, here's the question. I think when we rephrase the question, because this is a good one. So let's say we are at this point where, let's get that number. I'll just change this. So let's say we're at the point now where the asset is fully depreciated. Should you remove the asset and the depreciated, the 0 net book value? Should you remove both? Typically, no. You leave them on the books until you sell them. In some cases, you have more than one asset, so that kind of offsets. Some assets are over depreciated, some are under depreciated. But it's a very good question, because if that's the only asset I have, it shows up on my balance sheet with a net book value of 0. So the question is, should you zero those accounts out? And the answer is probably no. But it's a good question. So you've got a 0 at the end of the life of the asset. You've got a 0 of value. All right, so that's your review of deferred expenses. Now let's see what we can do with that review, hopefully. shortly. By the way, this first one we discussed, and the answer here is true. So just remember that prepaid expense could be recorded as an asset or an expense. Typically, it's an asset. Okay, typically, it's an asset. And remember that diagram where it kind of swings back and forth, kind of like that scale? Doesn't matter where you put it, eventually it will wind up in an expense. Okay, so here's a question I just had. I wasn't going to ask this one, but let me just let you know. Now this applies also to depreciation. So that in question number one, when a prepaid expense is initially recorded as an asset, the adjusting entry is the debited expense. Okay, so that's the depreciation expense you asked me about that before. So if you record something first as an asset in the adjustment process, the expense is going to be recorded. All right, so now I'm going to put you to work. Let's do number 2. And by the way, these are, let me just close this one out. So let's open this up again. Number 2. So you got a 2-year insurance policy for $9,600. I'm going to give you a couple of minutes to do this. I'm going to tell you that these are very similar to CPA exam questions. And if you look at the announcements I sent you to Blackboard, go over those periodically. I did give you access to Glime CPA Review if you're interested in seeing what a CPA exam looks like, what the questions look like. This is certainly similar to what you're going to get. The average time on the CPA exam to answer a question should be 2 minutes. So you're supposed to be able to blow through these multiple choice in 2 minutes, but let's just see. All right, good. So you got 76% saying that it's B, and that is the answer. Anyone want to volunteer and tell me how you got it? Okay.
From February 1st to June 30th, that's 5 months.
5 months.
Out of the 24 months.
Right.
So you can look at 9,600 times 5 over 24, you get 2,000.
Right.
And then, since it's recorded as an asset, you would have to reduce the asset, so that would be, your asset would now be a credit.
Exactly. Yeah, and the expense is done. Yeah, so what I normally do, I saw the way you did it, it's perfectly fine. What I would have done here is I took the 9,600 and I say it's a 2-year policy. So it's the same thing, and I get 400 a month and 5 months. So 5 months from February 1 to June 30. That's the 2,000. So you have a $2,000 adjustment that has to be recorded as a reduction of the asset and the increase of the expense. Question number 3. All right, this one's kind of spread a little bit. So I got the answer C here. That would be what I get, but since most of the class got it wrong, let's explain. Someone got it right. I'm checking the authors. I'm not going to call you again if you help me out. So someone that got C. So C is the correct answer. You want to explain how you do that? Someone just guess. All right, well, it's interest for 6 months, right? So here's the way I got it. Hopefully it's right. You got 10,000 note at 10%, and it would be for, this would be $1,000 a year, but it's a 6-month note, so it's 500 for the year. So that would be your for that 500 for the 6 months, I should say. 500 for 6 months. And that would give me 83.33. And the number of months, July through October. It's 4 months. that's an accrued expense. It's an accrued expense.
Will you please go back to the question?
I
I think I get it, but where would I conclude that interest is for the year?
well, no, I'm just saying I want to get the annual interest, so this loan is only going to be outstanding for 6 months. So the interest can only be, it's an annual note. The rates are always annual, so that's your question. So, good point, yeah.
It's
So
something
it's going to be
general.
a 10% interest for the year. It's an annual rate. All right, so it would be a debit interest expense, credit interest paid. All right, so, all right. Let's go to next. By the way, this one, there was a typo in this one. I guess it's not very clear when, this one was tough because you don't know when the actual period takes place. This is a typo. This should really be 1750, or you could change the problem to make it a Wednesday, which I'm going to probably do, but I'm going to tell you the answer should be D on this one. It should be, what they're assuming is that you've got 7 days accrued. So, so I'm just going to give you the answer on that one. It should be D, but there was a typo on that. So, it should be a debit, 1750 credit 7. And it should be 7 days accrued if it's on Tuesday. This question is not very clear, but it was also a typo. That was a publisher's typo or simply a textbook typo. All right, so the answer would be D. So here's what I want to do. I want to give you a few more minutes on this one. I want to do 1 or 2 of these. I'll give you the answers to the others. But number 5. I'm going to tell you, use T accounts for this one. This is what I call accounting gymnastics. So you've got to back into numbers here. So let me give you 3 minutes on this one. Number 5. All right. Let's see. Somebody who got C? I mean, I want to. Someone can explain that. But I get a different result.
That's B.
So how would you do? You're going to draw a T account for me. So I'll put the T account. And I got prepaid insurance. And I got a beginning balance, right? It's going to be 64. And I got an ending balance, which is 75,000. And I expensed. Where does that go in the T account? If I expense the debit or credit side? Credit. 150. Now, if I leave that as it is, I don't get a balance of 75, correct? I'm going to get a balance of 86. So that means that there must be, there's an unknown in here, which should actually be the amount prepaid. And what's that? What should that be? Did we get that number?
161.
161. That should be 161. So it should be B. The answer should be B, which was the least response. So, this is what I call accounting gymnastics. So that's something you got to get used to. You got to get used to plugging these accounts.
I don't know if this was maybe like luck or like an educated guess or not, but could you also do the math like?
Oh yeah, yeah. You could do it mathematically too, kind of an equation or a schedule.
Yeah.
Well, you got to get used to using T accounts because that becomes the language or notation. But that's fine. Yeah.
But I'm saying if I got the same answer,
Well,
you
sure,
guys,
that's
that
fine.
necessarily
Yeah.
the
Oh,
wrong
no.
way
Yeah,
to
multiple
do it.
choice. You want a CPA exam?
Yeah, okay. All right.
Do whatever you want.
All right, perfect.
We're going to give you some multiple choice, but mostly the multiple choice is gonna be the theory. And Tim, let me just go on a little bit further. I'm gonna tell you that on an exam, I might say, give me the T account.
Yeah.
So yeah, you gotta work it through. Okay, all right, so the answer would be B. Now, I'm gonna tell you, I'm gonna give you the answers for this one, and we're gonna move on a little bit, and I wanna get those diagnostics out also. Do the same thing for this problem. This time you're gonna get the expense, and the answer is also B in this case. 225. And I want you to work these out on your own and ask me if you have any questions. And then actually number 7 is B also, so I guess you can always answer B on the test. Oh. Okay. Anything else? Now, again, what you need to do, self-assessment, very important. When you get back those exams, so we're going to do that in about 5 minutes. Make sure you look at them. If there's something you don't know, don't ignore it. If something went on during the class that you don't know, don't ignore it. You need to ask me during office hours. I'm going to try to get here early. I forgot that this class was empty, but I did have a meeting earlier. I'll have office hours next week. I can always stop by my office after the 11:30 class. So make sure you get your questions answered. Leaving questions unanswered are only going to you're going to mount up. So make sure you. All right, last but not least for today. I'm going to start looking at deferred revenues. Again, we're still in the adjustment process. Step number 5. Yes, we know the deferral, the economic event is after the cash event is before. And here are the unearned revenues. And we mentioned before that unearned revenues are going to be your cash received in advance of earning revenue. We know that it's sometimes called an advance collection or a deferred credit. This is where a liability can result in being paid off, not by giving cash, but by providing goods and services. When you collect cash, when I asked the question before, when you collect the cash, you've got a performance obligation. You have an obligation to perform. That's either delivering goods and services, delivering a football game or a soccer game or whatever it may be, if someone pays you in advance, insurance coverage. This is where we get the liability-revenue relationship, and it looks pretty much the same as before when we did it with the expense. So here's the model that we started with this morning, and that is there is an upfront cash flow. It is recorded before the economic event occurs. We mentioned that you could record it. I know you have me with this. If you record it as revenue first, eventually it's got to become a liability or partially liability. But the typical way of doing this is you record the advance collection as a liability. That liability is then liquidated or paid off in a sense by delivering the goods or services. If you don't make the adjustment, the liabilities are overstated and the revenue is understated. The revenue is going to be too low. So examples would be rent collected in advance, any type of subscriptions. You subscribe to Sirius Radio, they give you, in fact, they give you the incentives to prepay, right? They tell you, pay for 4 years up front, and you get a discount on a car or something. Any other type of periodical subscription. You may subscribe to a journal online and deposits. Here's an example. We have Spicer Realty receives $90,000 from a corporate tenant in advance, in a sense, because it's for a 3-month period, October through December. October 1, they get the cash. October 31 is their end of period. What's the adjustment? Well, this rent is $3,000 per month. So every month, you would have to debit the unearned rent revenue and credit the rental earned. So once again, going back to this model, when you record it as a liability, revenue is recognized with the adjustment, and we reduce the. All right, so question, what was the original entries? Brittany, oh, you have these. Brittany here? Yeah, Brittany, yeah. What was the original entry? Not sure. Let's go back. Yeah. So what is this? Let's read this through. This is where the concept comes in. Concept tells you cash collected in advance. So if they got cash up front, what is that entry? Part of that entry. Cash debit. And if it's recorded as a liability, it's going to be a liability. Exactly. So the entry is going to look like this. And that would be for the full 9,000. So you see, if you think about it, you go back to the theory, definition, it's going to come into play. And that's why the definitions, the theory is much more important than the actual memorization of entries. And this happens all the time. If you take an exam and you memorize, and I decide to put the problem in a little different word or put it vertically instead of horizontally, I don't want you imploding. You really need to understand it. And so you'll get it. It's going to come. And again, you know that you're right because after 1 month, the balance is $6,000, and you've already recognized revenue.